Yeah, I think we can begin. We've got around 100 people, and people will obviously join. New listeners are gonna come. But hey, everyone, welcome back to Financial Summits, another spaces. This is a macroeconomic space which we do. We do it twice a week. One in the midweek where we are preparing, where we are talking about what is happening in the markets, and on the weekends when we do it, it's about preparing for the next week, about the economic calendar, and what can we expect with the price action as well. So, before anything, before moving into the spaces, I just want to tell you what Financial Summit is. So, it's an event which is happening this time. It's happening in Dubai from 5th until 10th November, and you are in a luxurious resort with people who are great in their field and industry. You've got professionals, you've got traders, businessmen, entrepreneurs. You can meet them. It's an IRL event. So in spaces, you're networking with people, you're talking to everyone, but meeting people in person, gaining knowledge, that is what is more important. And that's what we believe in as well. So you can check the tweet in the nest. You can go to the link, check out the website if you like it. And other than that, this is all free. The spaces, the education we are providing from different tools, for example, Bloomberg Terminal as well. So that is all free for everyone. But this is what we do, Gareth. This is what our team does. And you are here as a speaker today, and you're gonna be, talking to us, and we'll see how everything is going in the markets. So the first topic we've got in our hand is the US CPI, right? We can see from the last eight readings that the US CPI has been declining. And this is the first time when the forecast is greater than the previous one. What do you think about this? And do you think that, it's easy to go towards the 2%, which is the Fed's target?
So my view on it is that the last mile is the hardest mile, right? So it's easy to come down from such a dramatic amount of inflation as 9%, especially when there were so many disruptions in the supply chain that were kind of creating inflation. But the last little bit is going to be very tough, and I think we're seeing it, right? So I was just noticing today a big spike up in gasoline. Gasoline's close to 52-week highs, up about 15% from a month ago at this point. And then if you look at natural gas is soaring. I think it's up 50% off of the lows from this year. And then same thing with oil. Oil's broken out. I think U.S. oil has surged from at the end of June last month, it was around $70, and here it is at 84. So you're talking a 20% move. So I think in terms of core inflation, which Jerome Powell has said that that's really his focus since it affects middle and lower income the most. It seems to me that you might see a stall out in the drops in CPI, and it actually could kind of create a little bit of a hiccup for this market, I think.
Yep, that is perfect. And Powell did mention as well that getting to 2% is really it's going to be really really difficult, and they will be and they should be able to do it by 2024. But do you think this is a realistic target? And do you also think that getting to 2% is necessary, and by looking away from other things like unemployment and job numbers, let's say?
Yeah, so I think that it's going to be this new scenario for the Fed where we've had this period where, for now, I mean, heck, you could at least own up low grade kind of 1 maybe 2% inflation. And I think overall when you're under trend, if you look at the longer term trends of inflation, there's been so little that you probably are due for a longer period of elevated inflation. And I am concerned about the impacts on the ability for the to cut rates when it comes to that point, right, where we see a recession. Right now strong, so that's holding up well. But if that cracks, if you look at a lot of the underlying data points out there, there's a lot of weakness. Like, for instance, even though jobs have been strong, I was looking at data recently that showed that there was a pretty big increase in part-time work, but actually a decrease in full-time, which means people aren't able to find that full-time work at this point. And that's kind of the beginning stages of a labor market that probably is starting to weaken. And so for me, at least, I'm looking at it and saying, all right, if the Fed is telling us that it's going to take another year to get inflation down to 2% or even a year and a half, it's possible it could even be longer than that. And that really will make it so troublesome for the Fed to actually cut rates when the economy starts to sputter, right? So once we see that recession hit, and again, whether we're going to a recession this year or next year, at some point we will have one. And the key is going to be that the Fed has to get that inflation down so that they can actually print again and not cause an even bigger spike in inflation.
That makes sense. I think Tone, you're in the spaces, right? You're the co-host right now. I'm not sure if you're able to hear us. Yeah, just a second. I'm gonna fix this. Okay, perfect. So I've sent you an invite, Tone. But yes, Gareth, coming back to the CPI, yes, I do believe that, this is a very difficult situation we are in. And right now, when this downgrade has happened from Fitch, which is to double A plus, and it's not a very big deal, but recently we heard that Moody's has basically downgraded 10 medium-sized US banks, and this looks like a thing to worry, I believe. What do you think about it?
Yeah, so I think that, and again, a lot of people say, well, what the heck does it mean, a downgrade from AAA to double A plus? But in terms of us as citizens, it's the equivalent of having your credit score lowered. And ultimately, when your credit score is lowered, anyone you go to borrow money from is going to generally want to charge you a higher interest rate. And so that's really what it means for a country when their credit rating is lowered, is that it probably means that until we fix our debt situation here in the US with $32 trillion in debt and deficits going nuts, you're going to see a higher interest rate for longer. And that's really, and weirdly enough, the Fed has been saying that for a long time. They've said higher for longer, and the market has said, no, we don't believe you. I do think the markets might start believing in this higher for longer. If you look at the longer term projections for inflation, we're now at the recent highs. They're projecting out 5 years out of inflation around 2.5%. And that's dramatically higher than it was a couple months ago. So the market's slowly coming to terms with this. And I do think it's going to continue up. And I do think, it's very possible we'll see 3% for, to be honest, it could be for the next 3 to 5 years even. That means keeping that high.
Yes, exactly. Because as you said, right, in the end, it's going to be the most difficult coming to 2%. That is I believe the toughest job. But now the markets are finally reacting because every time we see an FOMC, it's all priced in, right? That's what we see. Every event is priced in already by the market. So whether it be 25 basis or 50 basis, but these things are usually priced in according to the probability. But when it comes to the downgrade, in 2011 also we saw that Dow Jones as well as S&P fell a lot. S&P fell 17% in a week, whereas Dow Jones fell 24%. And now it's doing it again. We saw Nvidia. Nvidia, I just saw today that it's trading 224x of its PE. Now,
Yeah.
these are the prices you should be scared of, or do you think it's the opposite, Garrett? Do you think this is the time when people should not be scared in the markets, let's say?
No, I do. I do. I've been sounding the alarm now for the last few months that the way investors are behaving is kind of a mob mentality where, fundamentals mean zero and it's just everyone jumping in, hoping to sell at a higher price. I mean, it's very reminiscent of meme coins where, it has no underlying value, but you're just willing to buy and then hope you can sell it to someone else for a nice chunk of change. And that really seems to be what has happened here in the market. So, I mean, I'm short Nvidia myself. At this point, it's nice to see it having a good drop today, but I think this is just the beginning. You've had these top seven stocks, the Magnificent Seven, and they've had such a run where so much market cap money has gone into these things. And now they're starting to correct, and we're seeing these cracks. We've seen Apple start to drop. We've seen Microsoft 10% off of its highs. Nvidia is finally starting to crack. So it's kind of the mob mentality in, and what investors have to understand is when that party ends, it's going to be mob mentality out. And you can get, it wouldn't shock me to see Microsoft down 20-25% off of its highs and still be at a high valuation. I mean, for those of you that are a little older that are listening in, back in the 2000 to 2010 range, in a neutral market, not really a bull or bear, the largest cap stocks had a PE ratios of 12 to 15. And here you had Microsoft with 30. Apple was a 30 plus PE. We know, Nvidia's multiples above that as well. And that's unsustainable. It's great in the short term when everyone's trying to clamor in, but at some point it has to come back to earth. And I think that process has started. And I think the downgrade was kind of a shot across the bow. Moody's yesterday talking about downgrading some of the big banks, same kind of deal, is it's kind of a recognition that it's not as simple as just getting inflation down. It's also a matter of, well, you got to get inflation down. You got to get the national debt down, debt to GDP from most of the big countries, even Japan. I mean, 250% debt to GDP is just insane to be sustainable. Now, if interest rates are zero, sure, you can borrow till the cows come home. You can borrow forever, but that only works. Debt to GDP being as high as it is only works when interest rates are basically at zero or in the low 1-2%. You get to 5%, 6%. There's no way a country can manage the amount of debt that the US has or Japan has or any of these other countries when interest rates are that high. And so there is a reckoning day coming. I don't know how far it can be pushed out, but there will be a reckoning day, and it's not going to be pretty.
I mean, yeah, I hear you. The only issue I've got here is that in 51 weeks, I mean, I've got chart in front of me from the lows of 3,500. S&P is up how much? It's up 28%, and it made a high of 31.7%. And from the all-time high, it's down only 7%. So when I look at this chart, I either see, technically I see a double top kind of structure, or I see an uptrend building with, good pullbacks, buyable pullbacks. If I keep away the news, what do you think about when you look at technically?
Yeah, so technically you're right. I mean, it's been a remarkable rally from the October lows. In fact, if this is still a bear market, this would be the longest bear market rally in the history of the stock market. So I mean, right there alone, that's impressive. The only other thing that I would say is that if you go to the dot-com bubble, if you go to 2007 when the markets were topping into 2008, the market is almost identical, meaning that you had the initial big pullback, which is what we saw from late 2021 to October of 2022. And then you had these big rallies. Now, again, this one has lasted the longest time of any of those. But if you align one on top of the other, they're almost identical, just that this one has lasted a lot longer. So that's a concern to me. It's a concern that market psychology is the same. You see people after the dot-com bubble initially collapsed, they all rushed back in thinking it was over. It was going to be a new bull market. In 2008, same thing, that initial flush, and people came right back in and said, oh, it's not going to be that bad. And then we know Lehman failed and the rest of the kind of dominoes fell. And so to me, I'm still very much on the line of saying I don't trust this rally. I don't trust valuations. I don't trust the fact that you can raise interest rates to the levels we've seen with the velocity we've seen and not have a bigger economic impact than what we've seen. I mean, is it really that easy to raise interest rates with the fastest velocity in history? And this is the extent of the damage that's done. To me, that's hard to believe. I could be wrong, but it's definitely hard to believe.
That makes sense, actually. So we are yes, don't go ahead, please. Your voice is cracking for me. Is it for everyone?
Yeah, for me as well.
Let
Oh,
me.
there.
I'm gonna shut down my phone. I'm gonna restart. I've just been having issues this whole time.
Now,
No
now we can
worries.
hear you though. I mean, this was good. Yeah,
No, I'm
but
still gonna shut everything down. I'm gonna restart my phone.
that's all right. Perfect. All right. So yeah. Yes. Now, Garrett. So we are comparing this from with 2008 crisis, and I'm not sure if we should do it fundamentally as well as, I mean, technically, yes, it's good. We are trying to find patterns, but fundamentally, I really want to know from you, what are the differences between the financial crisis and this time, and how this reset is going to be different, as well as how will it play out? How do you think it will play out?
Yeah, that's a good question. I mean, so fundamentally, the differences would be, I think that while you've had a big run in residential real estate, there's not, because of the low rates that were locked in, you probably have a different dynamic with people having very, very low rates for a lot of the homes that were purchased versus back then where they were. The other side, though, that could be looked at is that while the residential side seems to be okay for now. The commercial real estate side is an absolute catastrophe. So if we talk about, the commercial real estate, there's a lot of banks out there holding billions and billions and billions of defunct loans. I mean, they're essentially worthless at this point. The only positive is these banks don't have to realize them on their books, on their balance sheets yet, because they haven't gotten rid of them, essentially. So as long as they hold them and hold them to maturity, or whatever doesn't blow up, they're okay. So I think there's definitely differences in that period, but I also see a lot of similarities. I see the sentiment, right? I mean, the bullish sentiment that was in '07 is no doubt, or was no doubt, evident in 2021. So again, that would be the same. And I see the same thing. I mean, you could liken the .com bubble to what we saw in crypto, right, over the last couple of years with the insanity. I still remember vividly, it was the beginning of my trading career in 99 to 2000, when every .com, I mean, you could have the crappiest company run out of, some parent's basement, basically worthless, but the penny stock would go up 500%, 1,000%, 5,000%. And then you saw the same thing with crypto and the speculation in crypto. So again, there definitely are differences with '07, '08, '09, but I also see a lot of similarities.
So one thing I saw in because I haven't basically been I wasn't investing in that time. I'm doing my master's right now, Gareth, just to tell you. So I wasn't active at that time, obviously. But what I heard and what I studied was that the major impact was created from these credit agencies that were giving, false ratings, as well as there were a lot of ninja loans which were happening. But this time it's really, really different. And I believe that, the rating agencies are behaving in a very independent manner this time by downgrading the US, let's say, and now the banks as well. Do you think that credit rating agencies, we have talked about this in the past as well, past spaces as well, how important they are when it comes to coming out of a recession or going into a recession? What do you think?
Yeah, I mean, I think they do play a role, as long as people give them the power to. And I think when you looked at what Fitch did last week and what Moody's did yesterday, it's what we all kind of think, right? I mean, you look at the amount of U.S. debt, you look at where some of these banks are, and it's hard not to downgrade them. And so when Fitch did that, it's kind of like, I mean, it was kind of like, yeah, duh, that makes sense. And people were like, okay, wait, I have to readjust my risk portfolio now based on a double A plus rating versus a triple A plus rating. So I think that's part of it. I think it's all this chain reaction, because remember, just a week before that, we had the Japanese central bank loosening.
I think people got muted. Gareth, do you want to unmute yourself, please?
All right. If not, I think I'm back.
Hey, Tone. Gareth, you're still on mute. You can unmute yourself.
Okay, yeah, it said a host muted me, so I couldn't unmute
Really sorry
myself
about
for a
that
minute
again.
there. Oh, no worries. But yeah, so what I was saying is, yeah, and let's not forget, after, before the Fitch downgrade, we saw the Japanese central bank essentially loosen their yield control, and then they actually had to jump back into their bond market and buy bonds because the yields began to spike so quickly. So it's kind of this, in a weird way, you're seeing higher interest rates with higher inflation cause what has been building for, you could argue, decades to now start to unravel. And I think that's my big fear, is that, while it's not the financial crisis that we see in that respect, which was much more on an individual, right? If you look at the financial crisis of '08, '09, it was much more on an individual bank basis, on an individual home loan type scenario. I think this one, if we have some big event, some big credit crisis, it's probably much more on a larger scale with the countries and what it means for the U.S. debt and for the bond sales, the treasuries, stuff like that, and its impact on the overall economic picture.
That is perfect. That is perfect. Thanks a lot for that. This is, I think, the most important topic that people want to listen to, which is how are the two crises different? I won't call this crisis, but still, maybe we are leading towards that. But Tone is back. Hey, Tone, you've been hearing, right? I'm not sure if you've been
Yeah, I mean, I've
listening to
heard
it.
I've heard most of that. It was great how we just went right into the topic, which will be awesome for our YouTube viewers because this is going to go up on YouTube. Gareth, we'll get your intro in a bit so you can give us a little bit of a background as people are still coming in. It's great. Let's go with the discussion a little bit. Hopefully you still have at least 30 minutes for us, and then we'll definitely get to finding out a little more about you as well. So based on what you've said, I'm just going to throw a couple of comments out there and happy to have a little chat on everything you said. So well, we're going to talk about the CPI a little bit later. So on the inflation, on the actual inflation side on the ground, and the gas prices are going up because the price of oil is going up. And as you know, I've been covering it on my YouTube channel for at least a year now, constantly, this ridiculous depletion of the Strategic Petroleum Reserve from the Biden administration. Then they put out a statement recently that they're having trouble and they're going to pause adding back to the Strategic Oil Reserve. And then the data just came out a few hours ago, and they bought 1 million barrels. Like it's insane. They've been selling oil like crazy. And now all of a sudden, now that the price of oil is at an annual high, all of a sudden they bought 1 million barrels of oil. This makes no sense whatsoever. This is going to lead to higher prices at the pump. This is going to lead to a CPI print, maybe not the print that's coming in tomorrow, but next print is going to be higher. It's insane how they really have no idea what they're doing. Why were they selling 3 weeks ago or like 4 weeks ago only to buy back this week? It makes absolutely no sense. But that's going to contribute to the CPI. I have a slightly view on the markets. I have been bullish on the markets since that October low. Since the moment we reversed in October, I remain bullish on the markets. I think this is just a little pullback. I think the markets are going to go to a new all-time high, the stock markets. Probably not this year. It's a little bit too much of a climb. But next year, I'm expecting a new all-time high. And it's not because America is doing anything great. It's because that these high interest rates are actually causing the bond portfolios to continuously do so poorly. And a lot of the bond investors are going to start investing in stocks. I don't think the PE ratios matter right now because of speculation. If people think that the stocks are going to go up higher, they're just going to speculate regardless of what the PE ratio is. Eventually, it's going to hit the ultimate top and it's going to crash. But I think that the bull market in equities is coming and everyone is going to be ridiculously surprised.
Yeah, it's fascinating. I definitely think that's always a possibility, right? So when I'm looking at the markets, I'm looking at past cycles and whether it's the 07, 08, 09 period or 2000. And then you can also look at different cycle highs, which were closer to what we saw with Bitcoin, where Bitcoin actually made in 2021, it made a higher high before collapsing. So I think there's two possibilities there. I think for me, it's looking at kind of the scenario of how quickly does the jobs market, the employment market slow down. And if you're right, if we stay strong on employment and, you know, the markets can tolerate $1 trillion in credit card debt, which is now what we've hit, and, you know, the deficit continuing to expand more and more, then there's nothing to say we can't continue higher. I mean, it's always a possibility. For me, it's just, maybe I'm just looking at the writing on the wall and thinking it's going to happen sooner than it does, which wouldn't surprise me. I've been early in calls before, but for me, at least, I would have to see the high of 2021 taken out, and then I would say, okay, now the next leg up is actually here.
Yeah, and my view on it is, like I said, it's not because America is going to have this like robust growth. I just see American stock market as a safe haven for pretty much the West. Europeans have nowhere else to invest their money into. I think Europe is completely collapsing, and the only place for them to actually hide their money is in the American stock market. I think with the big energy problems that are going to hit all across Europe, we thought that the gas was...
I think we lost tone again, if I'm not wrong. Or is it for me?
No, I lost him as well.
It looks good on my end. You guys lost me again.
Oh, yeah, we lost. Yeah, we hear you again.
Back. Okay, sorry about that. Oh, I also see Joe Colasari. See if you can shoot him an invite, Kapoor. And is Joe gone? I'm not sure. It would be great to get him on. And So my view is the U.S. stock market just becomes a safe haven, not only for Americans, because now with this downgrade of U.S. debt, and rightfully so, what if another rating agency downgrades it? I mean, the U.S. debt is now offering a decent return of 4 or 5%, but a lot of people are going to see it as a potential default risk with how much interest the U.S. government is paying. It's just that government bonds are becoming a very risky asset. I mean, there is a reason why people aren't investing in Argentinian bonds, even if they pay 20%, because the risk of getting zero is just too high. And to me, the big boom in the U.S. equity market is coming only because there's nowhere else for people to put their money. It'll basically be stocks, maybe gold, and Bitcoin, but a lot of people are still scared of Bitcoin. And I see those as the safe haven assets, while the bond market is 10 times the size of the equity market. And there's plenty of money left to go into equities. And these PE ratios are going to get blown out of proportion. I think it's going to be like 1929 all over again.
Yeah, I thought about that too. Like, the 100-year cycle, right? So then you have essentially are we about to enter the Roaring Twenties, essentially, which back then led up to 1929 and the 30s depression. Maybe the AI boom does contribute to that. Maybe that does kind of lead into it. So that is a possibility. There's no doubt about it. I think for me, it's kind of struggling with, you see the Federal Reserve trying to unload their balance sheet. They've already reduced its sizably, so they're trying to contract that money supply. That M2 is starting to come in, and so is there enough money in the system still? And you're right. I mean, overall, we still are the best house on a bad block as the U.S., but again, I'm starting to see other foreign countries begin to pop up. Like, for instance, there's an amazing chart, the EWZ, which is breaking out. It's the Brazilian stock market chart. Hasn't hit a new high, I think, since like early 2000, but it's actually starting to break out of a wedge pattern. So I do wonder if the Fed's leniency over the last 10 plus years drew a lot of foreign money in, but is that money now going to look for someplace else if the Fed is not being as lenient?
Yeah, that's a great point. I haven't looked at the Brazilian stock market in a while. I'm curious how the Mexican stock market is doing. Their currency has been absolutely booming, and I think Mexico is another hot area. Indonesia's coming up as well, and I think India has a fairly bright future. So there's lots of countries that could be stepping up, and it'll be interesting. But yeah, the Roaring 20s, that's what I'm looking at in the future. And the AI boom, I've talked about that as well. It'll allow companies to shed their biggest expense, which is human labor, and one person replaces the work of two people if that one person knows how to use the computers, which is basically what AI is. And I do see that benefiting stocks quite a bit. I've been talking about this for years now, and it's great to see very few people are as bullish on equities as I am, and that gives me more confidence it's going to catch people by surprise.
How do you view like the scenario with AI, right? So AI could be a hugely beneficial thing, and it will be hugely beneficial for mankind. It may have some huge drawbacks too. We don't know how the negatives will work out. But one of the things I'm seeing is like, okay, so AI will make a company more profitable, but at the same time, it's going to cause layoffs. So assuming, let's say, unemployment starts to rise because people are being replaced with AI, those people no longer have jobs or money to spend, which then could affect the other side, right? The buying goods side, the consumer side. So do you have, what are your thoughts on that?
So I think the demographic is going to change a little bit. See, like a lot of these countries, America and Europe, are trying to bring in like as many immigrants as possible. And I think the shift, the pendulum on that is going to swing. I think that I still think there will be jobs. People will, find something else to do. But I do think AI is going to benefit. It'll be humans have always adjusted. Yes, there could be unemployment. Yes, people will not be able to spend a lot of money on luxury goods. But these are two independent things. I'm not saying that the United States is not going to go through this very bad recession. It's just that there is this inherent assumption in people's brain that a recession means a crash in the stock market. And this is where I've taken this weird view over the last couple of years that we can see high inflation, we can see high unemployment, and we can see a booming stock market. because those with money are going to continue to buy into companies. The mom and pop small stores are going to continue to struggle the way the government almost killed all of them during the COVID lockdowns, where a company like Amazon benefited at an expense of a retailer where you walk in person. And that benefits the stock market, that benefits Amazon, right? So those are two independent things. People struggling to make money and the stock market rising are completely different things. The majority of the people investing in the stock market are not people that are going to be fired due to AI. These are not people that invest in the stock market. Now, the pensions of these people do invest in the stock market, but those are already large funds, and they will continue to move into the stock market, even potentially more so than they have in the bond market. So the amount of money going into the stock market potentially will only increase because the gap between the rich and the poor is going to grow. The middle class is going to slowly disappear, and the middle class really only invests in stocks through these big pension funds, but they're going to continue to exist. The amount of money that they have is not going any lower.
That makes sense. So, guys, we've got good amount of people, and Gareth, this is the time when we can do your introduction as well. It's been 34 minutes. We directly dive into the topics, but go on.
But I
You
can
tell
hear
the
him just
listeners.
now. Gareth, can you say something?
Yeah, I'm here. Sorry
Okay,
about
good.
that.
Good. Okay, I hear you again. All right, cool. I'll let you have it.
Was that for me or for?
Yes, Gareth, if you want to go ahead, give your introduction about your firm, what you do to the listeners, because we've got good
Oh,
amount of people now.
all right, thank you so much. I appreciate it. So, my name Gareth Soloway. I'm a chief market strategist at Verified Investing, and basically, I've dedicated the last 20 to 25 years to just trading. I'm a day trader, a swing trader, macro analyst, and just basically studying past chart setups and data points to give me an edge, a slight edge on the future. And so again, you can find me at Verified Investing. I appreciate you guys inviting me on here. And you can always follow me for free on Twitter and YouTube. Those are two great spots to get great information as well. So I thank you guys for having me on. Really, I do.
All right, awesome. Hey, Gareth, do you trade options at all, or have you ever traded options? Because that's what I was usually trading, swing trading options on usually NASDAQ stocks.
Yeah, so I did do options for a while, and then for me, I've gotten a little bit away from it because I had a lower success rate. Like I always had trouble because options were so volatile. I'd find myself down 30-40% on it, and then if I cut it, usually I'd make the option would go right back up because they're so volatile. And then so I honestly had a lower success rate, so I kind of cut options out because of the risk. But I know people that trade them amazingly well. I've now really just focused in on stocks and ETFs in terms of swing trading and day trading, and crypto a little bit, but more so just swing trading. Some of the big ones like Bitcoin, Ethereum, and a few of the others.
Gotcha. Yeah, thanks for that intro. Kapoor, if you want to throw me a co-host, that'd be great as well, so I can kind of see who's on. And Joe, of course, you're always invited to speak in these spaces. Joe Calasari is joining us. All right, cool. All right, I'll give it back to our host.
Yep, guys, we had a nice talk about the US CPI, the job numbers, as well as the downgrade. We're going to go into the downgrade later on, and now we'll move towards Bitcoin. So Katie Wood came on, I think day before yesterday, and she had an interview with Bloomberg. Mike Novogratz had an interview yesterday, and Katie said a lot of things. Mike Novogratz as well about the insider information. He didn't say that, but he said that it's going to take 4 to 6 weeks for the decision to be there for the ETF. Now, the decision can be on either side, but what do you think about it, Gareth? What do you think this time will be?
So I'm leaning towards its approval or maybe a delay and then its approval. I do think that the SEC is trying to throw a bone to the crypto markets. They don't want to totally destroy crypto, and so I think they've recognized that Bitcoin is essentially a commodity. They're feeling more and more comfortable with it in terms of avoiding mentioning it when they talk about what securities are. And so I actually do think the fact that BlackRock and so many other big firms have gotten involved, I don't see these big firms not having insight with the SEC to being told, hey, listen, if you guys apply for this, we will approve it, right? I mean, if they knew it was not going to be approved, they honestly probably wouldn't have tried. So I do think it's coming. The question is it a game changer for Bitcoin? Are we going to all of a sudden see Bitcoin at the all-time highs? I kind of doubt that at this point. I still think that Bitcoin has a lot of struggles ahead of it, especially really a lot of Bitcoin is going to be determined by what the stock market does. And so if the stock market rolls over, I think you see Bitcoin kind of struggle as well. The positive on Bitcoin, I'll throw this out, and I think this is something we've seen recently, is that in March, when we saw Silicon Valley Bank fail, Bitcoin ripped higher, right? So as soon as there's trouble within the banks, Bitcoin is a safe haven now. Now, it's not a safe haven when it's just de-risking in the stock market due to recession fears, but specifically for bank issues, it is. And we saw that yesterday. As soon as that news hit that Moody's had downgraded a bunch of regional banks and was threatening to downgrade the big banks, Bitcoin actually had an update yesterday, right? So those type of things do get my attention. I do think there's a huge future for Bitcoin. I'm undecided on a lot of these other altcoins, frankly, because I just don't know which ones will last the test of time. But I think Bitcoin, again, has a really bright future. The question is, does it drop further first and then have a big run, or is it already bottomed?
Yeah, no, those are great comments. My view is none of these altcoins will have a future, but in the short term, some of them do bubble up, just like penny stocks. And I never traded the altcoins. I never traded penny stocks back in the day, and I had the same mentality over in the altcoin space. So just sticking to Bitcoin. Oh, Kapoor, we have a lot of good questions. Looks like your fans, Gareth, have asked some good questions over. If you guys have a question, yes, we do bring up people probably in the second hour to ask their questions. But otherwise, there's a button in the bottom corner, so you can leave a comment to the space. And you can ask a question and we go through those. I'll answer one of them real quick. I don't think inflation numbers have any bearing on the price of Bitcoin. I think the price of Bitcoin is somewhat correlated with the stock market, only from the perspective that they are both private assets, and very similar type of person speculates on the stock market that speculates on Bitcoin. And this is why usually stocks and Bitcoin are correlated within the same day, because it's the same speculator going bullish, like Bitcoin, like stocks, versus other days they could be bullish on Bitcoin because.
Oh, we're losing you again, Tone. Yeah, now I can hear you.
Okay. Where it's the same type of investor, which is why it creates some correlation. But inflation is not really a factor for Bitcoin all that much. I mean, if inflation was like 15, 20% in the United States and Europe, then yeah, I can see a lot of people moving into Bitcoin. People in Turkey love Bitcoin. The average Turk knows all about Bitcoin because their inflation has been going through the roof for like 3-4 years now. So they've had to learn all about Bitcoin because of that. But in general, a 2-3% annual inflation means absolutely nothing to an asset like Bitcoin. It doesn't even mean anything to an asset like gold. So I don't think they are. It's going to be reflected. And I also agree with the commenter. I think the U.S. dollar is going to go up because the dollar is measured against the euro mostly and other Western currencies. I think the dollar is going to go way up, but I don't think the stock market will go down. I think the U.S. dollar and the stock market will rally together over the next several years.
Yep, that makes sense. So we're talking about correlation as well. I think, Gareth, you touched on correlation. You were talking about that, if S&P falls, let's say, rolls down, then Bitcoin will follow. And you're a technical analyst and you're a swing trader as well. I'm sure you have, back tested a couple of strategies with correlation tests as well. What do you think right now, the correlation is? Because every time when markets go up, when S&P goes up, Bitcoin don't care. It's literally sideways. But when S&P is falling, Bitcoin follows it. So
yeah, so there's definitely that kind of correlation, right? So we've actually seen a very weird Bitcoin market where oftentimes Bitcoin, even when the markets are down, isn't doing a whole lot, and it's kind of been in its own individual world just for the last month or so. So I think a lot of that is kind of people's lack of caring right now, which is a clear sign of a bear market. If you go back to 2018, Bitcoin had a period where it, didn't matter what the stock market was doing. It didn't do a whole lot unless it was a massive move down in the stock market. So I think it's kind of in that period as well. I still remember vividly, CNBC used to always have the ticker in 2017 during the Bitcoin bull market on the bottom of their screen for Bitcoin. And then once it was in this huge bear market, they just kind of removed it and didn't talk about it. And that was actually a great signal of a bottom in Bitcoin. It was, $5,000 at the time or something off of the $20,000 high. So again, it definitely seems to kind of be in its own world right now. I think it's trying to figure itself out. I think, it's partially a safety asset when you have trouble with the banks, but then it's also still a risk asset, and people don't know which one it is. I don't think it knows what it is yet as well. So I'm kind of in like the camp where I still think, again, if the markets were to sell heavily, Bitcoin probably does get hit and could come down very quickly. But at the same time, again, there will be a bottom, and it could coincide with that spot ETF or some other event.
So that is all great, and I just want to ask you, for the listeners here who are trying to manage their risk in crypto markets, what is your risk management style here? Do you go with a deep stop loss when it comes to playing higher time frames in Bitcoin trades? Let's say, for example, right now we are under a very important resistance on weekly and monthly time frame, which is 30 to 32K, that range. So how are you playing it right now in this price action? And do you think we can, obviously, if we are getting rejected, if equities are coming down, we can obviously see lower prices for Bitcoin. So what is your risk management style there?
Yeah, so right now I have a small short out on Bitcoin as well as Ethereum. I'm basically flat on the Bitcoin short and in the money on the Ethereum short, and I basically have a mental stop. I use mental ones just because I don't like showing my hand in the open market. But basically, if we were to take out 32,000, I would probably exit that. And at this point, I probably have a mental break-even stop on the Ethereum since I'm in the money decently. So I'm right now angled to the downside. It doesn't mean that I won't flip my position if I see the right scenarios, or I won't cover my short. But I still think that based on the price action in Bitcoin, I'd be favoring right now the downside unless we take out 32,000.
So,
And
yes, Tom, go ahead.
What's your low end target, right? So let's say Bitcoin price does start to go down and your short trade on Bitcoin is doing nicely. Obviously, you're going to let it run. Where do you see a realistic low for Bitcoin? And do you think 25 has a chance of being taken out?
Yeah, so that's a great question. Right now there's a trend line. If you connect the lows going back to the low of Bitcoin, there's a perfect trend line aligning with the lows that is right coming up around 27,700 right now. So that's my first line in the sand for where it could kind of find support on any sort of dip. So it's not really that far away. If it breaks that, then 25,000 becomes a in play level, and if 25 breaks, then 20 becomes the big level there. Obviously, if 20 breaks, you're looking at 15.7. So it's very much like a stair stepping down based on technical support levels. To me, I still think that the worst case scenario for Bitcoin could be potentially down to 10 to 9,000, which I know is shocking to a lot of people, but if you had a scenario where we saw the stock market, coming back down to the October lows, right? So one of the things I think is fascinating, if and I wish I could show my charts on here, but if you look at the rally on Bitcoin off of its lows and compare it to the rally on the NASDAQ off its lows, the NASDAQ has retraced something like 75 to 80% of its move down. Bitcoin hasn't even retraced basically 30% of its decline from the all-time highs. And so let's just say the NASDAQ falls back to the October low. Is Bitcoin really not going to go back to 15,700 in that scenario, or potentially lower? It's hard to imagine it wouldn't. And so the thought process is, if we got a worst case scenario where the stock market really went into a tailspin, could Bitcoin hit max pain? I think max pain on Bitcoin would be a break of 10,000. It would just crush so many people and kind of be the final flush out. So that would be my worst case scenario. I don't think it's necessarily a high chance of that or high probability, but that would be my worst case scenario of about 10 to 9,000.
Yeah, really interesting view. I'm gonna comment on the same thing, but my view is a little bit different. I agree with you that 27,000 level is the ultimate support for Bitcoin for me. I personally believe we are in a bull market. And even if the stock market was to go against what I think it'll do and significantly correct, I think Bitcoin holds that 27,000. I think we are in a bull market based on certain cyclical patterns and the length of the bear market and how close we are to the halving. And in this case, if the stock market does go down, I think the banking system is going to be the cause of that. And therefore, Bitcoin could be seen as a hedge. But here is where your 9 to 11,000 becomes critical, is that my technical trading style will never have me buying a double bottom. I never buy double bottoms. I either need a higher low or I am 70, 80% confident the prior low is going to break if a prior low has been revisited. So based on that alone, if 27,000 doesn't hold, now 25,000 is a double bottom. Therefore, I'm not buying. If 25,000 breaks, now we're looking at 20,000 as a double bottom. I'm in the same boat. If 20 breaks, now 15 becomes a double bottom. So I would need 15 to break. The only way I'm buying a Bitcoin dip below 27,000 is if it's a sub $15,000 low. Otherwise, I would be only buying the breakout. And to me, the breakout is the $32,000, $33,000 area. And so based on all of that, I am ridiculously confident 27 is going to hold. Because if it doesn't, I'm going to be a very miserable person for the next 9 months.
Yeah, no, I agree with you. That 27-ish area is huge for me. I mean, that's the line in the sand where I still think there's a chance for Bitcoin to break out here. So as long as that holds, I think that's the one. But yeah, I mean, if that breaks, I think we both agree that things could get very messy very, very quickly.
So the major, Bitcoin is right now, as you said, that after the downgrade, Bitcoin pumped, right? And I'm not sure if after Moody's downgrade, Bitcoin pumped, or was it the Fed's oversight program for stable coins? Because there are so many, individual news going on.
Wait. Did I miss something?
Yep.
Wait, Moody still at AAA.
Moody basically downgraded 10 US medium-sized banks, and they have threatened
Oh,
some
okay,
large
got it.
banks
Okay,
as well.
they downgraded the banks. Okay, not US. That got it.
Yeah. So now the issue here is because, Gareth, if you remember, I asked you in the beginning of the spaces as well that how do credit rating agencies work? Do they work, independently, or is there any pressure from the, upside as well? But last week, when last week, I believe Fitch downgraded the US long-term credit rating. Then Jamie Dimon said, and a lot of big people, Janet Yellen as well, that this does not make sense, or is it long gone? It's long gone. And soon after that, Moody's downgraded regional banks, and they threatened the big banks as well, like BNY Mellon. BNY Mellon is downgraded. I mean, what they have threatened to, I think, US Bancorp and State Street, as well as Northern Trust. So how are you seeing this situation? What do you think, is happening right now? Because this is really, really serious, right?
Yeah, it has the potential to get out of control. And I think that's part of what Jamie Dimon and even Warren Buffett were saying, where, they kind of were brushing it off. And partially they're right? I mean, if you downgrade the US, how are you not downgrading every other country out there as well? Like we said earlier, it's, the US is still kind of the best house on a bad block. So I think that's a point. But at the same time, I think the point from Moody's and from Fitch is to say, what's going on in Washington with the, nuttiness, and what's going on with the debt, and just, these politicians, they don't care about the debt because they look at it like, hey, I'll be out of office when we got to deal with this issue. So spend so I can just get reelected. It's unsustainable. And I think that was kind of the point of it. And they're right. I mean, there will be. I mean, I always liken it to us individually. Like we all run our own households, whether we're single or whether we have a family, and you just can't spend endlessly on credit cards. At some point, the credit card shuts you down, right? So the same thing goes on with countries. Is like, yeah, we're the U.S. and people will be the last to be shut down, but at some point it starts to drag. And I think you have to look at it in a bigger picture of saying, if we're now paying $1 trillion in interest on this debt, that's more than our military budget. budget, which, by the way, is the biggest budget in the world. And it's basically you combine all the next countries and it's equal to theirs. So how much money is being wasted here that could go to actual growth, right? And I think that's part of it. And then you look at the individual consumer, credit card debt at $1 trillion as well, and how much interest is on that. And there's eventually you start to just suck the life. I mean, think about it like a vampire just sucking the life out of someone or the country when you're wasting. It's all waste when it goes to interest, in my opinion.
Yep, that is true. That makes sense. The first part was amazing, wherein you said that US is downgraded, but why not other countries? So that is 100%. But when I'm looking into the markets, when I'm seeing everything, all the indices are trying to make a new all-time highs, and people when they were talking about recession, no one is sure whether we are in a recession right now or not. If you look at the textbook definition, then we were already in a recession like 3 or 6 months back. But what do you think? Are we in a recession, or we are going into a recession, or do you think we'll see post-recession effects like 2008 when the markets fell? This is for Gareth here.
Oh yeah, sorry about that. I wasn't sure. But yeah, so I think for me, this is the hardest thing to kind of gauge is how is it all going to play out, right? Right off the bat, I would say that the potential is like Tony was saying, that or Tone was saying was that we would ultimately have something later in the decade that could be cataclysmic to the downside. Could it occur sooner? I mean, it could. I mean, if we start to see the credit scenario get out of control and yields potentially spike up and the debt ratings get cut again, I think that's always a possibility. But yeah, I mean, it's I wish I had a clearer picture for everyone listening to really give you guys a gauge on exactly how this is going to unfold. I just know that at some point you have to pay the piper when the amount of leverage in the system. And this is one of my issues with Bitcoin is while we're talking about Bitcoin potentially breaking out, I do worry about the leverage in the system. Like hedge funds are over leveraged, right? We know that individuals, even in the crypto markets, are using still 50x, 100x, and different things like that. And I do worry if you get a certain type of flush, you're going to start seeing margin calls hitting left and right. So I think that these different scenarios could be in play, and I think it could really uh, create a faster scenario where things collapse versus not.
Yep, that's for sure. And we saw that stock markets fell after the downgrade news. So, do you think there's a potential of a news coming in for Bitcoin so that we can increase the volatility here? We can see VIX is climbing up, and that happened after the US downgrade. And I really thought that Nasdaq would be a good news, like a big news as well, but it wasn't. And downgrade was a bigger one. But for Bitcoin, you've got the ETF, you've got, Fed, you've got SEC as well. There are so many things happening. What do you think will be the catalyst for the next move? Because volatility is literally at the all-time lows right now.
Yeah, and as we all know, the volatility, the lower the volatility, the bigger the move usually is the result. So I think there is a major move on the horizon in Bitcoin. The question again is it to the upside or the downside? The catalyst for that, I mean, for the bullish case, right? It's the approval of an ETF that would initially, I think you get as much as 10% on Bitcoin to the upside if and when that approval occurs, because there's going to be an instantaneous pop of people just rushing in. Um, does that get us above the 32,000 level? Can it hold above 32,000? I think that's going to be the key if that does occur. So I think that's one thing I'm kind of keeping an eye on here to see if it does play out. And then I think the other factors would just be clarification, right? Ripple, the deal with Ripple, the judgment for Ripple right now is getting appealed. That could be a 1 to 2 year process, and so I don't think it gave us a lot of clarity on the end results for a lot of these altcoins. And so for the next 1 to 2 years, or until we finally get through all of these appeals, it actually could be a scenario where you're just stuck for at least the altcoins in purgatory.
Yep, and as you mentioned that volatility is gonna come, it's just around the corner, and when there is a period of low volatility, high volatility is greater than that. But okay, so I want to ask you this question first. How do you measure volatility as an investor or as a firm itself? What do you see? Do you see charts or index?
Yeah, for volatility, I mean, definitely follow the VIX. The VIX definitely gives me a sense of what people's expectations are. So the lower the VIX, the more people usually are just like, this market will float up. There's nothing wrong. There's nothing that can go wrong. It's essentially a gauge of complacency, right? So the lower the VIX, and we've seen this, by the way. I mean, the VIX has gotten down into the 13s and so forth recently, and that's also been a concern for me. And now we're starting to see volatility pick up in the stock market as the markets are selling off a little bit more. So I think that's something that I watch for. Individually, I look for the stocks and the indexes to start to get volatile as well. But really, that VIX to me is kind of the indicator of where sentiment stays or is for the markets overall, and it's an investor sentiment, right? So it's the feeling of everything is fine, or it's the feeling of, oh my goodness, this thing could be really bad, and that's when the VIX is usually topping out. So I actually use the VIX, for those out there that are listening, I use the VIX as a contrarian indicator, right? So when the VIX was down to 13, I was slowly inching into the VIX, or VXX is a play here, as well as shorting stocks. And now as we're starting to see, the Microsofts fall, the Apples fall, Nvidia today's down over $20 right now, that'll be as the VIX spikes. Once it gets north of 20, I probably start to cover some of those shorts.
I think VIX is a good indicator if you're looking at the stock markets, and it was good as well when we were looking for crypto. But now it's really, really different because VIX has been going up from past 1.5, 2 weeks, whereas Bitcoin is doing nothing. So when
Sure.
it comes to Bitcoin, what do you look at for volatility majorly?
Wow. I mean, so for me, it's just following Bitcoin's price action. You can look at how tight the Bollinger Bands are right now on Bitcoin. Some of these other things, some of these other indicators out there. But really, at least when it comes to crypto, I'm not a big fan of a lot of the tiny coins out there. I really stick to the top coins and just stick with those at this point.
Oh yeah, and that's what we do. We only talk about Bitcoin on this basis, so it's good. We want to make sure we are in the right direction there.
Nice.
Tone, I think you're back once
I
again.
am back, finally.
Yep.
I
I'm
did
not
hear
sure.
most of what Gareth had to say. I just couldn't speak.
Okay, so we were talking about recession, and Tone, you've been saying that, we had recession. We have already been in that situation. Do you want to elaborate on that?
Yeah, so this is really interesting. So my view is we spent the second half of 2022 and at least the second half of 2022 and the beginning of 2023 in a recession. So in my view is we are actually exiting the recession now with the stabilization of house prices a little bit now that the interest rate is here to stay. I don't think the Fed is going to raise it much more, and people are just going to get adjusted to the current situation. Inflation is coming down a little bit, and I think that we're going to be exiting the recession around this time, and companies will be doing a little bit better. They already took their financial hit, and I think stocks are going to start rising. But last week, I had one of my friends on here he manages many, many clubs around the country, mostly down in Florida. And his view was the recession did not occur yet, and the recession is coming very, very soon, and the worst is yet to come. And he's basing this on just basically him running a business with a lot of money flowing through it based on how many people are partying, how many people are drinking alcohol, and how it's going. He's also a trader. He's been a trader for a long time on the side. And my view is that like a lot of bad economically happened already. And now what people are slowly getting out of it, just from a normalization perspective. And now that they're getting some kind of an interest rate, for those that have some money, you could earn, 4 or 5% at your bank. So it makes people feel a lot better. And I really don't think crazy bad times are around the corner. And I think the Biden administration is going to spend, starting towards the end of this year and into the election. So it's going to be interesting. The one thing that they have to do is they have to lower the gas prices. So I think they're going to really deplete that strategic petroleum reserve to crash the price at the pump. And the one thing I don't know is where the war in Ukraine is going to go. They can either end it tomorrow or they can escalate it. If they escalate it, it's going to be tougher for everyone in the West. If they end it tomorrow, then it could be much better.
Yep, that makes sense. So, the next thing we want to talk about is the ETF, but we're not going to talk the simple ETF talks which are happening everywhere, whether it's going to be, approved or denied, because no one knows, guys. No one knows what's going to happen, but we can talk about GBTC, right? So yesterday, GBTC closed the gap of discount by 7%. In the past week, it has closed the gap by 16%, which is amazing. So there's a case going on, obviously, we know about that. And what can happen is that GBTC has been one of the best bets since the BlackRock ETF news started on the internet and everyone came to know about it. GBTC has been the best, I would say, bet for people. So Gareth, how are you looking into it, and what do you think about GBTC versus other ETFs, spot ETFs?
Yeah, so I mean, I don't know a ton about it to be honest, other than that it was trading at a very steep discount to Bitcoin. I think since it looks more and more likely that a Bitcoin ETF will be approved, we've seen a very significant move up. Obviously, I'm looking at the chart right now. It was trading at $7.70 or so, and it's all the way back almost to 20. So we see a major outperformance versus Bitcoin itself. So I think that could continue to be a good play, since it's I believe, and again, people should do their own research, but I think it's still at a discount at this point. So it could offer a larger move to the upside versus Bitcoin if Bitcoin continues up. But aside from that, I don't honestly know too much more about it.
I'll comment on it real quick. I actually don't think the rise in GBTC and the catch up of the discount is not due to the spot ETF coming in. I think it's just due to Bitcoin's bull market since the lows. The way people need to think of GBTC is just that it's a contracted supply. So if you have the amount of Bitcoin out there in the world of trading on exchanges is probably about 1 to 2 million, and the amount of Bitcoin in GBTC shares is about 500,000 equivalent. So whenever there is a bull market in Bitcoin, there is more demand for GBTC than there are shares to go around, and it goes up a lot faster than the underlying product. But when there is a drop in the price of Bitcoin and people are bearish, people are selling GBTC, but nobody wants to buy GBTC. So it tends to fall a lot further and below the discount. And so many new shares were created of GBTC during the bull market that when the bear market began, it was over. Like no one wanted to buy GBTC because they don't have a bullish outlook for Bitcoin. And so the price of GBTC shares just went well below par. And now, because there's a Bitcoin bull market, people are sitting on their GBTC shares and they don't want to sell them because a lot of people are still in the red zone based on that discount. So I think that as long as Bitcoin is rising, GBTC shares will just rise faster in price, the way that gold miners tend to rise a lot faster during a gold bull run versus the actual price of gold. So as Bitcoin approaches its all-time high of 50,000-60,000, if it starts to do it very, very quickly, there'll be a rush for people to profit from the rise in Bitcoin through GBTC, and there's not going to be enough GBTC shares to go around, and that discount is going to evaporate very, very quickly.
Yep, and obviously there's a case going on. Just to give this to the listeners as well. GBTC is the third biggest position of ARK investment as well, which is amazing. They believe in it. Katie Wood believes in it, and she's been talking about it, how GBTC is going to win out of nowhere because no one is focusing on that. So that's one thing. I also want to touch upon open interest for Bitcoin right now. So the number of open, long, and short positions on all crypto derivative exchanges is literally at the all-time highs year to date, which is at $10.086 billion. And, obviously it's important, especially when you consider the high correlation coefficient between open interest and the price of Bitcoin. So what can happen? A lot of traders took advantage of this, the recent dip, which was at 28.7 or 28.6 on some exchanges to go long, and Bitcoin price can follow. but at the same time, in short term, it can be bearish as well. Now, Gareth, this is, a question for you, a little bit technical. You would love to answer this. Open interest, how do you see it, and how do you, use it as a strategy?
Yeah, so overall, to be honest, I don't use open interest a whole lot. I look at it on occasion. I do think it can be beneficial, but again, because most of my trading occurs in the stock market wise, I don't look at that too much. I'd love to hear Tone's view on this, though. I'm sure he kind of has a better view on it.
I'm with you, actually. I don't really, the only open interest that I really care about is in the option space. In the option space, I care about open interest quite a bit because I want to know how much liquidity there is in the options that I may be holding. But other than that, open interest.
I think we lost Tone again. Yep. Is it for you as well, Gareth?
And in the equity market, the markets are plenty liquid because I only trade S&P 500, NASDAQ 100. I don't really go outside of those markets. I never look at penny stocks. And in the Bitcoin world, same thing, just Bitcoin. I mean, if I saw an opportunity in Ethereum, I might take the trade, but unlikely. And but in the option space, I have been trading options where my friend and I had strategies back in 07, 08 days, probably some of our better profits that we made. And I remember one time I made a trade, and it was only for, I think it was a straddle kind of option trade where I bought calls and puts on a stock, and I only bought 10 options on each side. And I got a text from my friend who knew that it was me who took the trade because we were trading options on these stocks. The stocks were $20, $30 stocks with volume, but they just weren't that liquid in the option space. So he knew exactly it was me based on the 20 options that were traded. But I was trading with him. It was an old college buddy of mine. So just by 20 options moving, I did it.
And Tone, you used to do that for earnings, right? For all the earnings in those particular stocks because you were playing volatility and not the price. So earnings is one of the most important things, obviously. And we saw that a lot of companies have
lost you, Kapoor.
I can hear you.
Oh, Gareth can hear me. All right, so I'm gonna.
I hear Gareth, but I lost Kapoor. All right, I'll let you ask Gareth another question, and also take a look. We got a lot of comments to the space to see if there's any good questions over there.
Yep. So I'm gonna quickly move to this topic, and then we'll go towards the comment section, and we'll let people come up to the stage as well and ask their questions if they want to. We've got some time left on the spaces. So I literally forgot what I was talking about, Gareth.
I think you were mentioning earnings, and
yes, earnings.
And I don't know if you were. Yeah, I was just going to say, and just my response, because we just got Disney earnings out, by the way, and I'm just following that as we speak. And Disney looks basically flat to positive on earnings just a bit. But one of the things that struck me is that, I think the stats are about 80% of companies beat earnings. But if you look at how many stocks were up on earnings that actually rallied on those beats, about 80% were down. So there was a definitive kind of overpricing and under delivering. Even with earnings beats, we saw companies still selling off because the stock prices have rallied so tremendously in recent months. And so I thought that was kind of interesting. I also think that, everyone was so crazy about the AI, but what's going on with AI and the chip stocks. And we saw a lot of negative commentary. We saw Qualcomm getting crushed on their earnings, Taiwan Semi getting crushed, and even some of the other second tier ones getting crushed on their earnings as well. And I think there's two angles to it. One is that, number one, it looks like the chips for phones are really slowing down, and we saw that with Apple earnings as well. But also the AI craze, while it's going to be tremendous, it's kind of like the dot-coms. Like dot-com changed our lives. Amazon came out of it, but it didn't mean Amazon stock didn't collapse in the dot-com collapse because it got too high prior to it being able to generate the type of returns that people were pricing into the stock. So I think that's kind of interesting. It's like a weird phase we're going through in the markets right now where things got so lofty that even beats on earnings couldn't justify the current price action on the stock.
So what I understand from this is that, obviously we had lower expectations for earnings for every single sector, right? That's what, if I'm not wrong on that, if you want to confirm. This year we had lower expectations for every single firm sector in the earnings.
Yes, yeah. So you're right. Expectations were low. But what's interesting is that even though expectations from analysts were low, the stock prices rallied so much that the kind of the whisper numbers were much, 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 much higher. Because again, it's one thing to say, hey, a company should make $10 in earnings per share. If it's priced at $10, that seems like a reasonable valuation. But if that stock runs up to $1,000 prior to reporting $10 in earnings, all of a sudden it's way too expensive and it has to come down. So I think that's one of the things is expectations were low, but the stock prices created a higher level of expectation by their rallies to the upside.
Yeah, and that is 100% true. The only thing I can one more thing I'm seeing here is I really want to, hear from you what you think about this. So earnings expectations were low this year and this quarter and the last quarter as well. Let's say that it's low in the next quarter as well. Why? Because obviously we are in this, difficult environment, but at the same time the stock market is going up, and 7% from the highs is nothing, right? It's just a healthy pullback in an uptrend, let's say. Let's call it a healthy pullback. So the next time as well, the expectations will be low. And if the numbers again beat the expectations, then people will see it, right? And that is the time when I see that, okay, now it's been two straight quarters. Majority of the companies are beating expectations. Doesn't matter if the expectations were low or not. So this is bullish, right? This is bullish because they're beating expectations. The stock market is not falling as well. So do you think that this is good to say as well that, okay, with lower expectations, we are beating them. The stock market is not falling. So this is really, really bullish.
Yeah, I mean, again, I think it's a little bit more multifaceted than that. So, I mean, it's one thing to have low expectations and being able to beat them, but then it also you have to look at the price action. And I think at least what we're starting to see now, and again, this might just be a healthy pullback. I mean, in all fairness, like you said, the markets have been on an incredible run. That a pullback of what we're seeing right now is just your run of the mill retrace, really. The bigger question I would say is what are we seeing from the Magnificent Seven, which have such a major influence on the indices? I mean, really, 50% of the Nasdaq 100 is seven stocks, and about 25% of the S&P is these same seven stocks. And what would concern me is we're starting to see cracks in their armor. Right? We've seen Apple drop, Microsoft drop, Meta's did really well, Google did really well, Amazon did really well, but again, not all of them are kind of performing at their mega levels to keep the market up. And so right now, the markets haven't fallen too much because I think there's been second tier companies that have kind of taken over. Money flow has gone out of the Apples and then found a resting place in other areas of the market. But the question is, does that continue, right? And I think really, whether it's the CPI data tomorrow, that'll be interesting to watch, or just any jobs data in the coming months to really see if it's just your run-of-the-mill pullback or if it becomes something bigger. Just looking at the S&P 500, and I'm just going to bring up this chart on my screen here. I just want to kind of gauge a level to watch. So I have a really important technical level at around, bear with me here while I bring this up, SPX. So I'm looking at a very important technical level around 4,440 on the S&P 500. I think as long as that holds, then this market continues to be somewhat on the safer side in terms of a pullback. If that were to break, I think that starts to get a little bit nastier in terms of the potential repercussions for this market.
And that's perfect. We got your technical levels as well. I'm sure everyone has noted them down. Tone, what are your technical levels, if you're able to hear us,
Yeah, for which market?
for the S&P? So I mean, yes, I personally I am scared a little bit. Gareth, myself, I'm a technical analyst as well. I recently completed my CMT level one on part to do the whole CMT, and I can see some fears. Right, we are creating a lower high here, but at the same time, I see this as an uptrend. and I'm going to buy every single throwback which happens on the trend line or maybe at my horizontal supports. That's what I look at, right?
Yeah, for me, it's 4,400. I just don't see the S&P going lower than 4,400. There is for me, there's a nice trend line there outside of like one candle that broke below it on a weekly scale. A moving average line, probably the 20, is coming up in that area. It's also where the high was in back in August of 2022, so a year ago. The high a year ago before the final leg down going into October. I would find it hard to believe that the S&P goes below 4,400 before creating a new leg up, and the next one will likely take us to a new all-time high.
That is perfect. All right, so we'll move towards the next question, and then we'll go towards the comment section as well. So, Gareth, you were mentioning about the credit card debt, right? And really want to know what you feel about that, and how do you think it's you mentioned that there are two different economies right now in the United States. Do you want to elaborate on that, please?
Yeah, yeah, absolutely. And then just one note, guys. I'm gonna have to jump off around 4:45 p.m. Eastern time just to make a note of that. Just I gotta finish a little work before the family dinner tonight. But just going back to what you guys were talking about in terms of two economies, you really have the economy of people that have wealth and are invested in the stock market, and those people inflation's not really hurting them, right? They're making so much money in the stock market with this run up of 40% on the Nasdaq, 20+% on the S&P, that who cares if prices have gone up X amount? They're able to handle it. Then you have everyone else, right? And we're starting to see that if you look at the consumer confidence. And so consumer confidence we know has been very, very strong over the last few months, and that's directly correlated with the stock market. But if you break down consumer confidence by income, you actually see that the higher income brackets, the consumer confidence has soared, while the lower income brackets have actually gone down significantly in terms of consumer confidence. And what that really shows us is that if you don't have investments, you're getting hit by inflation without any sort of additional money coming in, and there's really a major difference there. So again, the Fed keeps on talking about fixing the inequality in the U.S. or it's a world issue really, but everything that's going on is just exacerbating that. And I mean, I know we were talking about AI earlier, and the same thing for AI. I mean, you're going to see the lower paying jobs get replaced probably by AI, and the higher paying jobs will probably stay around. And I think, again, that just exacerbates that inequality.
And yes, for the listeners as well, total credit card debt in the US jumped from 45 billion in 3 months to a record $1 trillion, which is amazing. And we are back to the pre-pandemic levels. So this is not good, right? And what do you think the end situation here is, Gareth? Do you think there will be some kind of defaults? Obviously, there will be a lot of defaults, but how does this end? And will it put pressure on the institutions who are basically giving credit to the retail?
Yeah, I think that's going to be the issue, is that how much exposure do the institutions have, and then how does it reflect back through the economy? I mean, does it become in a few years like what we saw in 08, 09? Again, it's hard to know for sure, but I do know that the stats are starting to get worse, right? So you had, during the pandemic, people had so much savings, and that really has carried us through. And I think that's one of the reasons why the economy has stayed so strong. Consumers have been willing to spend, but problem is now they're getting through it and running up credit card debt. And one of the things I know, and this is just from myself as well, is that once you get to a certain level of living, you saved a lot of money. Now you're used to going out to eat 3 times a week. You're used to, buying a little bit nicer stuff. It's very hard to go back to spending very, little. And so I think people have gotten accustomed to a certain lifestyle because of during COVID, and now it's hard to cut back, which means they're running up debt. Well, that's only sustainable for so long, right? And so eventually you're going to see people not paying their credit card bills. In fact, I think I saw a stat that said 7.6% of loans are now in default 30 days or longer. And that's actually a new all-time high. So while the economy itself is still doing well, one of my cases for why I'm nervous about the next couple of years is that the underlying stats, there are worrisome trends starting to form. And again, to be honest, when you raise interest rates from 0 to 5.25 to 5.5 on the Fed funds, it's hard to imagine that you're not going to break some things, right? I mean, it's just the nature of things.
That makes sense. We'll quickly move towards the last topic, and it's in the comment section as well. So there's a confluence here. Firstly, a quick question. What is your favorite moving average if you like moving averages, Gareth? I know it's a lagging indicator, but still.
Yeah, no, it's a good one for sure. So I mean, in general, I love the larger time frame moving averages. So something like the 20 moving average, unless you're a trader that's trading a little bit more quickly, I for one don't use that as much. But like the 200 moving average is one of my favorites. The 150, those because it's such a long series of data points, I find tend to be much stronger. And what's even more important, and I think this goes for technical analysis overall, is that if you're going to buy off of a moving average, I love to find a secondary indicator as well. So is there a gap fill there? Is there a pivot point? Is there a trend line? And if you can get two factors for buying a pullback, you're going to have a better success rate than just the 200 or just the 50 moving average. So it's really about, for me, it's about finding the more multiple factors for every trade. And the more factors you find, the more likely you will have a profitable trade.
That makes sense. All those moving averages are really, really important. And I believe the mother of all moving average of averages, obviously the simple moving average 200, which you mentioned as well. So I've got a question regarding the SMA 200 on weekly time frame for oil. Now, oil, since tapping that moving average, is up 25%. What are your targets for it? What are you looking fundamentally? Because that's a big move, right? In literally 6 weeks.
Yeah, it's a huge move on oil. And again, to me, we did just break above a short-term high here, which again, there was resistance on the WTI crude chart at around 83. And today we closed or we're right around 84.20. So short term, that's a strong move. But having said that, it is an extended move on oil, right? I mean, oil has gone vertical from, late June, it was $67, and here we're at 84. So for me, this is where I start to look for trend lines, and I start to say, okay, well, it's extended. I know that it's breaking above this level, so it might have a little bit more to go. But if it goes a little bit more, where can I start to maybe inch in on a short trade? And again, this is a swing trade, so mind you, we're not talking like longer term. But I will say this: I have a trend line I'm drawing in on my charts that goes back to 2021 and connects through about 4 or 5 points, and it's right around 87 and a half or so. And so for me, at least, if oil were to pop to, let's say, 87.50, 88, I'd probably look at a pullback scenario there on the chart.
Yep, that makes sense as well. Because okay, so what I'm looking on weekly time frame is I'm looking for a perfect double bottom here. I'm not sure if you're looking at that as well. From starting from December 2022 until today's price, and I can see the breakout has already happened, and there is an important resistance on in 25th October 2021 as well.
Yes, I see that as well. Yep.
Yep. So I can see that the move has already begun and it has tested the SMA 200. Yes, any pullback here would be bullish, but if we look at it fundamentally, which side are you on right now for oil?
I mean, so if you ask me in the next 6 to 12 months which direction I think oil is going to go, I think it's going to come down. It doesn't mean it's not going to go up to 87 or higher in the near term, but I do think that you have the elections coming up, and I think that there's going to be, generally heading into big elections, oil trades down. You have to kind of help the economy along, and I also think that at some point you'll see the labor market decline, and at that point the worries, whether we do hit a recession or not, there's going to be worries about a recession, which is a demand issue. So for oil, those would kind of culminate with a pullback. Wouldn't even shock me if in a year and a half we're back down to 66 or 65 on crude oil.
That makes sense. Just for the listeners, Disney earnings are out, as Gareth mentioned as well. I'm just gonna say the numbers now. Third quarter revenue, 22.3 billion, 33 billion. Estimate was 22.51, which is flat. Adjusted EPS is higher than expected, but again flat. The Disney subscribers for third quarter, 146.1 million. Estimated was 154.8. Again, we can see, Gareth, right? So we know that, right? Earnings can be adjusted, earnings can be false as well because there can be accounting, you know, things or manipulation that you can do. Do you believe in that? Do you believe that accounting manipulation makes sure that earnings are not correct for the
Yeah, I mean,
firms?
there's always little loopholes, right? So one of my biggest things is like share buybacks, right? So for instance, one of the easiest ways to make your earnings better is by buying back stock, in which case you have less outstanding shares and therefore earnings per share goes up automatically. I mean, Apple's king of doing this, right? So even though Apple's stock was hitting a new all-time high, the market cap for Apple actually only hit a double top at its highs, which is kind of fascinating if you think about market cap double top, and that's where Apple stalled and actually had to collapse back down. So just kind of things like that to be aware of. And there's always accounting, issues you can do and so forth. Like I still remember back when Tesla was a couple years ago when it was having these crazy runs in 2021. They used to use these credits that they could sell to other automakers based on their EV production, and that was just like a massive amount of extra money that came to their bottom line. So I mean, there's always little loopholes that can be done. Overall, the best predictor of whether a stock is doing well or not is price action, right? So I always say, look, what is the chart doing? And this, by the way, this even goes for commodities. So everyone's like, what do you think oil inventories are going to be? Are they going to beat? Are they going to miss? And I say, well, just watch price action. That tells you whether or not the big players think it's a good number or a bad number. And that goes with earnings as well.
That makes sense. Okay, so we've got Scotsman. You have a question about Japan. You want to go ahead, please?
Yeah, sure. Hey, Gareth. I'm just curious, with oil spiking so high and the Japanese yen so weak, when do you think it is that Japan's, step in to defend the yen? And then what impact's that going to have on the treasury yields? Because if you look at them today, I mean, you're getting strong yields across the board. So do you think that's likely to lead to a capital outflow from equities into treasuries? If you're getting 5% on a 10-year treasury, then that's a significant return.
Yeah, you're right about that. And so I mean, I do think that there's trouble brewing with Japan and with the carry trade. I'm actually looking at the dollar yen chart right now, and we're literally, if you could take the high from 2022 on the dollar yen, which was about 152, it connects right through the high of July 2023, and we're now hitting in August of 2023 that trend line. If that breaks out, I think that sets off another ripple effect through this whole market scenario. So I do think there's some issues brewing here, and I do think that oil is a part of that, as well as honestly just the whole idea of the yen, the YCC, the yen, the control of the yield curve. You're looking at an economy that has been accustomed to zero interest rates for decades at this point, and because of inflation now, they're having to adjust that yield higher, that interest rate higher to combat the inflation. And I mean, think about how used to everything. I mean, you're basically taking the norm of where interest rates in Japan have been for decades at this point, and now you're saying, hey, things have to change. And so it makes a lot of sense that it's going to send ripple effects through these massive economies. And things have been banked on these connections between the dollar and the yen and everything like that for decades. And so there's going to be some hiccups and there's going to be some rumbles. And I think as investors have to expect for the next 12 months, if not longer, volatility is going to increase. We're going to wake up to a lot of mornings on the stock market here in the US with some big moves because of things that are happening overseas.
Yeah, definitely. I mean, if you look at the last time the yen was this weak against the dollar, oil was at $69, whereas versus today. But I just wonder how you think, capital moves into these treasuries if the yield spike caused by Japan. Do you see that as a risk? And then does that mean the Fed has to print even more to cover this interest expense?
Yeah, so I mean, and this is going to be the $1 million or $1 billion question, right? Is that how much intervention can the Fed do? We know when the banking crisis hit in March of 2023, they actually did intervene and pump money into the system, and now they've been withdrawing it again. So we know that the Fed will come to the rescue. The question is again, how does it affect inflation? And I don't know if we can argue that their intervention in March of 2023 has helped some of these commodities start to lift off again. But it'd be interesting to kind of do analysis on that. But I do think if yields do pop, there's no doubt that it's going to send ripple effects through the markets, right? I mean, the higher yields go, the more people can say, why am I risking, especially in a stock market that's starting to get more volatile? People do have an alternative. And compared to the alternative of just a couple years ago, it's a pretty dang good alternative of getting 5% guaranteed on your money. So, I mean, I think that's something to keep an eye on.
Yeah, and then you've also got the amount of shorts that are in the treasury market right now. That could form.
Yes, way over leveraged.
Yeah.
Way over leveraged.
And
Absolutely.
actually, on the chart, TLT looks like it's performing a double bottom. It looks like it could lead to a double bottom in the next few weeks. But thanks. Sorry for taking up too much time, but thanks, Gareth. Thanks for chatting that through.
Oh, great question. Great question, by the way.
Well, I'll comment on Japan as well. Was actually just there for like 3 weeks or so, a few months ago. So I'm looking at Japan's like currency history, and Japan's currency is as weak as it's been in the last 30 years. But prior to that, it was a lot weaker before that. The price of oil being around 80 right now versus in the 60s. I just don't think all of it matters all that much. I mean, yes, Japan eventually had to raise its interest rate a little bit, and they can try to raise it to 1 or 2%. It's not going to make any material difference whatsoever. Japan should have never had a zero interest rate policy. No country should ever have a zero interest rate policy. Japanese interest rates should have stuck around in that 1 to 2% range at least. And yes, Japan is going through a little bit of inflation right now, but they are a very self-sustained society. So if they have no contact from the outside world, their society will function just fine. People still have a lot of demand for Japanese goods because they are of incredibly high quality, even though that quality has been going down over the years. And now with the Japanese yen being weak, there'll be more demand for Japanese goods being built in Japan. My family used to drive Subarus all the time. And we always only bought the Subarus that were built in Japan. Like I used to own the WRX. My dad used to have a Subaru Forester. He loves driving that car. And it was always, those two cars were always built in Japan. The Outback is built outside of Japan. So we weren't really interested in that, even though it's still a Japanese car. So also, I don't think Japan matters that much on a global scale. This is not the 1980s where Japan had the second biggest economy in the world, all because of its hardworking people. China, India, even Russia, Mexico, Indonesia. I mean, these countries are about to matter a lot more than Japan. Like, I'm sorry, but Japan is just not that important anymore. And if Japan really cares about cheap energy, all they have to do is make a deal with Russia, and they'll get cheap energy. So Japan has plenty of solutions. I remember, like, I started trading in the early 2000s, and I remember for over a decade, for 15 years, I kept hearing how Japan is imminently going to collapse and is going to cause all these ripples through the economy. And then I worked on Wall Street for a decade. And around 10 years ago, I said, you know what? I'm tired of worrying about Japan. I don't care what happens in Japan. And my life as a trader has never been better. The more I ignored Japan and the Japanese yen and the inevitable collapse of Japan, the easier my trading life became. And I still don't understand, when I eventually grew out of it, why so many people still care about Japan.
Well, I guess the point is that they're the largest holder of U.S. Treasuries, and their people haven't had inflation for 40 years. So now introducing inflation into a country that's never had inflation, that's going to pose some challenges to the Bank of Japan and the government. That would be where I would see the risks. But I agree with you that there's always been this doom around Japan. I get that. But when they're one of the largest holders of US Treasuries, inflation's out of the bottle. And as we know, once inflation gets out, is very hard to tame. And I think the Bank of Japan thought they could create a little bit of inflation. And I think with the price of oil, they're going to quickly realise that you can't just turn a tap on and off with inflation.
Yeah, I mean, the holder of U.S. Treasuries, that is true, but now the U.S. Treasuries are actually paying a decent interest rate. Now, the interest rate that the U.S. is paying on its debt is eventually what's going to implode the United States. But the United States can always pay Japan in cheaper U.S. dollars, and U.S. dollar can still go up because Europe is in a way worse shape than Japan is. And when the euro implodes, the value of the dollar and the demand for the dollar will be great. And the dollar, I believe, is going to strengthen. So once again, Japan could be the beneficiary of a strong dollar, with the United States paying Japan back in dollars, while Japanese currency is weakening. Them holding U.S. debt is them holding a much stronger currency. Though technically Americans own the majority of American debt, but yes, Japan is now the biggest holder. China is deleveraging of U.S. debt. Russia has already cut all of their U.S. debt. I don't think India is not in a rush to really buy U.S. debt. And Japan will get left holding the bag, but the United States will stop paying Social Security before they default on their debt, probably, right? Because if the United States defaults on their debt, they are surrendering world reserve status of the U.S. dollar. So Japan's got at least another decade before the United States officially defaults on its debt. They got time. They got plenty of time.
Yeah, thanks a lot, guys. This was a good discussion. Thanks, Scotsman, for starting the discussion. Amazing. We've got very little time, Gareth. I think 6 minutes left for you to leave the spaces, and that's a really bad thing because we want to, learn more from you. But quickly want to go and ask you the closing statements. How are you looking at the markets now? What are your closing statements? What do you want to tell the listeners?
Yeah, so I think that investors in stocks specifically, to me, you do have to expect buy the dip. So technical support should be bought at this point. But I would just say to stay nimble until we take out the recent highs. So the recent high on the S&P or the NASDAQ, whichever one you're looking at, buy the dip mentality is ingrained in this market. So it's going to happen. Even if NVIDIA falls to sub 400, it will get a bounce at some point because buyers will jump in on these plays that have been running and have been working for years at this point. But I do think that you got to look at the CPI data tomorrow. That's going to be huge at 8:30 in the morning. That'll guide us probably to, I'm guessing, a Fed that even if it's a little hotter, I still have a trouble thinking the Fed's going to still increase rates the rest of the year as we're seeing more kind of breakages in the system, debt downgrade, stuff like that. And then I think overall with Bitcoin, you just kind of watch that 32,000 level, and then on the downside, watch the 27,000 level. Those would be the two levels there. Lastly, I've been picking up a little bit more gold recently. While it's not the sexiest thing, it's not going to make you hundreds of percentage points in a market where there's some uncertainty and the volatility starting to spike. To me, it offers kind of a sleep well at night option, so it's not my whole portfolio. It's just a portion, but it's a good place to diversify and kind of tuck a little money away for at least me in this kind of a little bit more elevated VIX area.
Thanks a lot for that. Yes, guys, I just want to say that the median for tomorrow's CPI is the forecast is 3.3. The median from all the major banks is 3.3 as well. Only JP Morgan is sitting at 3.4%. And through my, stupid backtesting of looking at this number and I've seen that JP Morgan has been quite right. So that's a hot CPI number. But yes, I agree with Gareth that there should not be any rate hike this year. But Tone believes in the opposite, I guess. Tone, you're looking at one more hike this year, right?
I'm looking at least one more hike this year, potentially two. And if we don't get a second hike, it might be coming in January, right? So I'm giving myself the first meeting of next year as another potential. I think the interest rate from the Fed will be 5.75 at least, 5.75 or 6. I think 6.5 is their ultimate ceiling, and I think the goal of Jerome Powell is to get the rate to 6%. And keep it there for as long as he can or as long as he has a job, because whoever is the next president will bring in a different Fed chair, potentially even before his term is up, and that new chair will only get that job if they are on board with the Treasury and lowering of the interest rate.
Perfect, guys. We'll end the spaces here. It was great talking with you, Garrett, Tone, Scotsman, everyone coming to the speaker stage. Thanks a lot, people, for everyone to asking your questions as well in the comment section. I hope you enjoyed, Garrett. I hope this was a good spaces for you as well.
Yeah, it was wonderful. Great discussions, great viewpoints, and yeah, great all the way around. Thank you guys for having me. It's truly been a pleasure.
Perfect.
Yeah,
And
thanks,
I hope
Gareth. And hey, feel free to jump in on anytime you see these spaces on your Twitter. Feel free to jump in. We usually do have several speakers, not too many. We don't like to have like 8 speakers, but usually like 3 to 4 people is a perfect way to have a discussion like this.
Perfect. I'll keep that in mind. And thank you.
Thanks a lot, guys. And for all the listeners as well, if you don't follow us, give us a follow. You can check out what we are doing, Financial Summit, as well as, Verified Investing, which is Gareth Soloway's firm. So you can look at it, you can see what they are doing as well. And we'll come back on Saturday or Sunday, to prepare for the markets next week. Tomorrow, CPI is one of the most important things happening. You should have a look at that as well. But until then, guys, we'll take your leave. Thank you so much for joining. See you later. Bye. Oh, I just saw Joe requested to join. And really sorry, Joe, we are just finishing up the spaces. Thanks, guys. Bye.